So if you're trying to make sense of the U.S. housing market for 2026, man, you are not alone. It is a really confusing picture, right? One headline tells you prices are stabilizing, and the next one is screaming that a crash is just around the corner. So what's the real story? Well, over the next few minutes, we're going to cut right through all that noise. We're going deep, deep into the data to show you this massive, unprecedented split that's dividing the country into two completely different markets, these surprising safe havens and some really dangerous red zones. And by the end of this, you'll know exactly what to look for in your own city. Okay, let's get into it.
On a national level, the forecasts look, well, kind of boring, right? Most of the big analysts are calling for some modest home price growth for 2026, somewhere around 2 to 4%. This number right here, 3.1%, that's pretty much the consensus. Now, if you just saw this number, you'd probably think, okay, a balancing year, a calm sea after the storm of the last few years. You might just shrug and move on. But you know what? That would be a huge mistake, because this number isn't just misleading, it's an illusion.
And this is why that national number is a total illusion. While the average is just kind of floating along, on the ground, a massive tectonic shift is happening. I mean, look at this. In Toledo, Ohio, home prices are projected to surge by a huge 13.1%. At the exact same time, down in Cape Coral, Florida, they're forecasted to plummet by 10.2%. That is a staggering 23-point spread between the best and the worst performing cities. This isn't one single market. It's a great divergence. The idea of a national housing market, it's effectively dead.
So that brings us to the big question, right? What powerful forces are literally tearing the U.S. housing market in two? It's not just one thing. It's this collision of new economic realities, a couple of hidden crises, and this fundamental shift in where Americans actually want to live and what they can afford. We are going to unpack all of it, and we're going to start with the one number that changed everything.
Welcome to the new normal, folks. The era of 3% mortgage rates, what some people called free money, that is definitively over. The consensus among the top economists from Zillow, Redfin, the National Association of Realtors, they all say that 30-year fixed rates are going to stabilize right in this low to mid 6% range for the foreseeable future. And this one single shift has created a powerful market warping phenomenon that's basically locking up the entire system. They call it the lock-in effect, or sometimes you'll hear it called the golden handcuffs. And the concept is simple, but it's absolutely devastating. Just imagine you're a homeowner with a 3% mortgage. If you sell your house and then you go buy another one for the exact same price, your monthly interest payment would pretty much double by taking on a new 6% loan. I mean, why would you ever make that move unless you absolutely had to? This massive disincentive has frozen the supply of existing homes for sale, creating a kind of market paralysis we haven't seen in decades. And this isn't some small niche problem affecting just a few people. Over 80%, 80, of current mortgage holders in the U.S. have a rate that is substantially lower than today's going rate. JP Morgan Research actually calls this the single biggest constraint on housing supply. It's so powerful that the only people really selling are those forced to by what they call the 3Ds: death, divorce, or default. For pretty much everyone else, staying put is the only rational financial move, which is effectively starving the market of inventory. So, with supply totally frozen and rates so high, what happens to affordability? Well, it gets absolutely crushed. This number, 47.7%, comes from the Atlanta Fed. It's the percentage of the median household income that's now required just to cover the payments on a median-priced home. And to put that into perspective for you, the historical norm is closer to 30%. This brutal reality has split the market into the haves. Think cash buyers or repeat buyers with tons of equity, and the have-nots, first-time buyers who are almost completely priced out. And this affordability crisis is a huge reason why some cities are just hitting a brick wall. Okay, let's move to the first half of our divergence story, the danger zones. These are the cities that were the darlings of the pandemic boom, the Zoom towns and the Sunbelt hotspots. But the very things that fueled their meteoric rise are now conspiring to trigger a really painful correction. But this isn't just about high mortgage rates. It's a perfect storm of several factors all hitting at once. First, builders who were trying to meet that crazy pandemic demand, they flooded these markets with new homes. Now that demand has cooled off, there's a glut of empty, speculative inventory. Second, a lot of major companies are ending the whole work-from-anywhere experiment, yanking remote workers back to their hub cities. Third, and this is a big one we'll talk more about later, insurance costs in these climate-exposed areas are exploding, adding thousands to the annual cost of owning a home. And finally, the big Wall Street investors who are buying up single-family homes, well, they're now quietly heading for the exits. And we can see exactly where that storm is hitting the hardest. Florida is basically the epicenter.
Cape Coral is facing a staggering 10.2% drop, just crushed by a post-Hurricane Ian insurance crisis and a flood of investor-owned homes hitting the market. Nearby Northport is in a very similar boat. But it's not just Florida. Stockton, California, and Spokane, Washington, cities that were these sort of affordable overflows for San Francisco and Seattle, they're seeing that value proposition just evaporate as return-to-office mandates kick in. Even a major hub like Tampa isn't immune. It's facing its own unique condo crisis on top of everything else.
All right, now let's pivot to the other side of this great divergence. And this is where the story gets really unexpected. While the Sun Belt is sizzling and correcting, a completely different region is quietly booming, the Rust Belt and the Midwest. These legacy cities are becoming America's new safe havens, and the logic behind it, it's incredibly simple. So what's driving this? Well, to put it simply, the market is having a massive flight to safety and to value. Buyers and investors are fleeing the high costs and the high risks of those coastal hotspots. And where are they going? They're going to places that offer two things the danger zones just can't anymore: genuine affordability and relative climate resilience. In these Midwest cities, a median income can still comfortably afford a median-priced home, even with 6% mortgage rates. And you're not facing the existential threat of your insurance premium tripling overnight because of hurricanes or wildfires. The results are a complete reversal of the trends we've seen for the last 20 years. Toledo is leading the nation with a projected 13.1% gain. Syracuse is right behind it, getting a huge boost from a massive investment by Micron Technology and its reputation as a climate haven. Scranton, Rochester, Hartford. Look, these aren't speculative bubbles. This is what we call catch-up growth. These markets never had those insane 100% price run-ups like in Austin or Phoenix, so they have really solid fundamentals and plenty of room to grow. They represent the last bastions of attainable homeownership in America. Okay, so we've seen the great divergence, but beneath the surface of these danger zones, there are two hidden crises brewing, and these are basically financial time bombs that can just detonate with very little warning, destroying a property's value almost overnight. The first one is unfolding right now in Florida's condo market.
It all started with the tragic collapse of the Champlain Towers. In response, Florida passed a new law, SB 4D. Now, this law does two critical things. It forces older buildings to get really rigorous structural inspections, and more importantly, it makes it illegal for condo associations to skip saving money for future repairs. For decades, boards kept monthly fees artificially low by waiving these reserve contributions, and now the bill has come due. The result is what people are calling an assessment shock, as owners are suddenly getting hit with these enormous bills to pay for 30 years of neglected maintenance all at once.
And the human cost here is just staggering. We are talking about special assessments of $50, $100, even $200,000 per unit due immediately. For retirees on a fixed income, it's absolutely devastating. This quote captures it perfectly. It's not just an inconvenience, it can literally double their cost of living overnight. If they can't pay it, the association can put a lien on their property and actually foreclose. This has frozen the market for older condos because buyers are terrified of the unknown liabilities they might inherit. The second time bomb is the insurance crisis, which is no longer just a Florida problem. It's become a national contagion. Insurers, battered by years of massive payouts from wildfires, hurricanes, and storms, are hiking premiums to levels that are fundamentally changing the math of homeownership. In Louisiana, premiums are projected to surge 27%. In California, 21%, with major insurers like State Farm just pulling out of entire zip codes. In Florida, the average premium is approaching a jaw-dropping $15,500 a year. Just think about that. An extra $10,000 a year in insurance has the same impact on your monthly budget as adding another $120,000 to your mortgage. It's like a silent crash, just destroying purchasing power and home values.
So, what does all this mean for you? Let's build a personal playbook, a clear strategy for how you can navigate this market reset, whether you're looking to buy, sell, or just understand the value of your own home. This all comes down to a practical, actionable checklist. Here are 4 things you absolutely must investigate at a hyper-local level. First, don't just get an insurance quote. Ask about the trend. Is it available for multiple carriers? Are they projecting big hikes? Second, if you're looking at a condo or an HOA, demand to see the reserve study. Is it fully funded? Because if it's not, a massive assessment could be coming. Third, look at your local inventory. Is it mostly existing homes, which suggests a stable market, or is it flooded with new construction from builders who might start slashing prices? And finally, what are the big employers in your town doing?
Strong return-to-office mandates could boost values near job centers and really hurt those in the distant suburbs. And this brings us to the single most important takeaway from this entire explainer. Forget the national headlines. In 2026, the idea of a U.S. housing market is a statistical fantasy. It's an illusion. The only thing that truly matters is what's happening on your block, in your neighborhood, in your city. The risks and the opportunities are now entirely local. So that's the question you really need to ask yourself. As this great divergence accelerates, the difference between building wealth and losing it all comes down to understanding your local reality. Are the fundamentals in your market pointing towards a safe haven like Toledo, or are the warning signs flashing for a danger zone like Cape Coral? Are you positioned to catch a rising star, or are you about to catch a falling knife? We really hope this deep dive gave you the clarity you need to navigate the road ahead. The housing market is going through a fundamental reset, and understanding these structural shifts is more critical than ever before. If you find this kind of detailed, data-driven analysis helpful, please take a moment to like this explainer, share it with someone who might need to see it, and subscribe to the MoneyWise Dollar channel for more just like this.
And now we want to hear from you. The real story is on the ground, right there in your communities. So what trends are you seeing in your local housing market? Are you in one of these boom towns, or are you in one of the danger zones? Share your observations and your experiences in the comments below. Let's get a conversation going. Thanks for watching.